Welcome to the Dairy News and Views podcast, a production of the Iowa State University Extension and Outreach Dairy Team. Our podcast covers current educational, research, and industry tools available for your operation to manage healthy cows and calves while producing the highest quality dairy products. Thanks for joining us today on Dairy News and Views from the ISU Dairy Team. I'm Jenn Bentley, Northeast Iowa Dairy Field Specialist. In today's episode, we're joined with Fred Hall, Northwest Iowa Dairy Field Specialist, and Matt Tranel, a risk management advisor with the Commodity Risk Management Group, as we visit about milk marketing, a topic that seems ever-changing in the year 2020 here. So welcome today, Fred and Matt.
Good morning, Jen. Glad to be here.
Good morning. Thanks for having me.
Yeah, so Matt, I mentioned this is a kind of a very unsettling year, some very highs and lows. What can you say? What is causing this volatility in the current milk market?
Yeah, the simple answer for 2020 to all the volatility is uncertainty. When we kind of take back the clock to January and February, the market wasn't all that bearish at that point in time. Ultimately, there was a lot of optimism in the market. Ultimately, when COVID-19 struck and really struck the United States, the certainty as to how bad prices would get, or economically speaking in the United States it would get, caused a lot of fear. When COVID struck, we had most of the market players all jump into one side of the boat. They all wanted to sell at the exact same time because it was kind of a risk-on scenario. Anytime there's uncertainty, you have great volatility, whether that's up or down. In this case, because nobody knew how the milk market was going to play out, and knowing that we had a perishable product and there was a lot of talk of dumping milk, everybody wanted to be on the short side of the market. So everybody was either selling milk or they were buying coverage via insurance or via put options in a market. Really drove a stake into the milk market, taking it down as far as $10 a hundredweight, and ultimately settling with a low in May Class 3 milk of $12.14. At that point in time, there was a lot of talk throughout the industry about how do we help out the dairymen, how do we help out grain farmers, how do we help out the livestock industry, because those industries were hurting just like the dairy. And so many of the lobbying groups within the dairy side of things started asking the government for some help. Ultimately, when we were down towards some of those levels, the government came in many different ways to help dairymen throughout the country. And some of the programs that were enacted, and this one kind of goes back a little ways, but Section 32 purchases, that one actually started way back in 1935. And that allows the government to purchase surplus product and basically divvy it up throughout the country to different food banks and different nonprofit organizations. They also use trade mitigation purchases as a way to fund dairymen. They use the CARES Act, and the most popular one as of late is the Farmers to Families Food Box Program, which is currently still running. The USDA earmarked $1 billion to buy and deliver dairy products throughout the country. Ultimately, when you look back at government purchases, typically you're at about 0.2% roughly of what the government accounts for in milk production. And as of this moment, in the past couple of months, the government is actually into milk production for about 2.5%. So they account for 2.5% of the milk production that they're purchasing right now. So it's a significant increase in purchasing. And at the same time, we've seen a ton of different changes in this market as well. You're seeing historic volatility in eating habits. When you look at when COVID-19 struck and you look at dine-in restaurants, between early March and basically mid-May, dine-in reservations were down 100% because food service was, in essence, closed anywhere it was dine-in. And when you look at the United States as of the end of June, we're still down about 60% from normal. And the unfortunate part in that space is that there's an estimate that 25 to 33% of those dine-in restaurants might not ever come back. And at the same time, you're looking at retail demand, grocery stores, demand for dairy products being significantly higher, which has been a really, really good thing. I come back to uncertainty because the market is still trying to figure out where it all fits moving forward from a demand structure. Does retail continue on the pace in the future, or does dine-in come back? Nobody really knows how that plays out. Dine-in over time likely comes back and services more and more consumers, but until we really get there, nobody knows when that will happen or how much will come back. Uncertainty is really the driving force to a move lower, but also the move higher. Right now, everybody in the market is trying to figure out how long this government bid is going to be available. We just extended the Farmer to Family Food Box program into September and October. We're starting to run out of money based upon that $1 billion that was set aside in that program for dairy. The government could still purchase via Section 32 if they decided to. Everybody's just trying to figure out how long that will last. And when the government really came in, we were talking about traders all being on one side of the boat on the way down. Well, on the way back up, most of the traders were on the other side of the boat. They were long the market, they were buying the market. And so that's really what led to a higher market and where we find ourselves here today.
I think there were a couple aspects of that overlook that's really important. First, the market reacted the way the market's supposed to. You know, the market is to find a price that can clear product, and it obviously worked. The second thing is, as we changed the structure of the food chain, we had to retool some things. You know, if you're a processor and you were making a product for the institutional side, you just didn't turn the switch and make product that went into the home market. So, you know, it was an amazing paradigm that we'd never actually seen before. And as you said, the uncertainty caused the volatility. One of the big things as we talk about volatility is our actual federal market system and how we price milk. The typical expectation is that the highest minimum prices are for class 1 and milk values decline all the way through class 4. Now, or we experienced when the class 1 price was lower, especially in the upper Midwest and Central orders, than class 3. And we actually, and Matt, I know you're in the upper Midwest and most of my producers are in the Central order, but we saw that occur 12 months. And, you know, I think that helped me explain why this volatility caused these negative PPDs or producer price differentials.
Yeah, so ultimately when you're talking about producer price differential, you're talking about class 1 milk, fluid milk versus manufactured milk of class 3 and class 4. So to get to a class 1 price, basically you take 50% of the class 3 and you take 50% of the class 4 price and you add 74 cents, and that's how you come to your class 1 price. However, the PPDs really came into play because class 1 is always announced before the class 3s and the class 4s. So for example, class 1 for the June pricing, the last check that we got for PPD, it was announced on May 20th, 2020. Whereas when you look at the June price announcements for class 3s and class 4s, they didn't happen until the end of June and beginning of July. If you think back to what was happening back in May, that's when we were putting in a low in the market for May milk. It was $12.14 for class 3. And while we're not talking May milk, June milk was not that high for class 3 or class 4, and class 4 really still isn't that high, but class 3 wasn't very high at that point in time. So we were announcing the advanced prices for class 1, whereas the government came in and really started to purchase cheese products, and class 3 by settlement time was at $21.04 a hundredweight. So the disconnect between Class 3 and the Class 1, and also the Class 4 and the Class 1, really caused a significant PPD, and in this case, significantly negative. In a normal market, like you had mentioned, Class 1 is typically the highest price out of all four classes. More times than not, on a dairyman's check, because of the federal milk marketing order, Class 1 producers would actually pay into the pool, and you would actually see a positive PPD on the Class 3 and the Class 4. However, when you have a massive spread like we currently have and had in June, it causes a very, very negative PPD. And unfortunately, moving forward, it looks like that will continue over the next couple of months as those spreads are significantly different. Right now, you have a Class 3 price for August at $21.67, and that's Class 3. For Class 4, we're at $13.63. So the wider that these spreads continue, the more and more negative PPDs we would likely see moving forward.
I want to kind of point out that, each class has products that's made from it. And we reference Class 3, and we're really looking at the price of protein, butterfat, and lactose. And, as those prices are determined by the processor, what they're able to market. So when they have that swiftly moving market, they're paying more out than they're going to be able to capture back from the pool, and that creates the prospect that there's a lot of milk depooled. That's not part of that scheme, and we're seeing that now, aren't we?
Yeah, absolutely. I mean, in areas especially that you have a lot of Class 3 exposure and utilization, you're especially seeing depooling taking place as Class 3 is at a higher value. And so when there is a lot of milk that is depooled, typically your PPDs in certain federal orders are even higher. Whereas in like the upper Midwest, if a ton of milk is depooled because there's such a high utilization to the Class 3, it can actually decrease some of the PPDs that the buyers can offer their patrons. I know in Wisconsin specifically, I've heard, even though the upper Midwest was a PPD of $3.81, I've heard a lot of producers receiving $1 PPD to $3 PPD and not necessarily that $3.81. The reason a lot of buyers within the federal milk marketing orders don't necessarily make a rash decision to depool a lot of milk at one particular time is that it takes a lot of time to get back into the pool, as you can only increase your milk that's pooled by 25% each and every month. So it takes a lot of time to get that milk back in. So if the markets would come back into a normal relation, they wouldn't necessarily reward producers for being in that pool if they can't get the milk back in.
Well, I'm going to shift gears just a little bit. We've been talking about the supply and production side. As we look forward, what the world economies are suffering. Almost the entire world's been affected by COVID. We are seeing it with the high unemployment here in this country. But what are you seeing for the world economic condition and milk prices? I know EU is moderating production, but will demand suffer because of the economics of the communities?
Yeah, I mean, the short answer to your question would be yes, demand will suffer. I mean, I like to kind of relate it back to the United States. Whenever a consumer in the United States has more money in their wallet, they tend to spend more. And it's no different with any of the other export partners that we would work with. In Mexico, currently they're dealing with a breakout of COVID, where it seems to be a little bit more out of control than maybe what it has been in the past. Ultimately, that will more likely than not limit some of their purchases of U.S. dairy. Recently they've been pretty decent players on the non-fat and the skim milk side of the equation, any of the dry powders, but many of the other export export opportunities that we see with Mexico have not been as high. I know cheese is kind of in a different arena right now with us being priced out of export opportunities throughout the world. When you look at the Middle East, North Africa, countries that pump a lot of oil. When COVID hit, oil prices in the United States went negative for a day. And so their economies are driven significantly by oil and oil prices. And when oil prices are subpar, they are not going to open their checkbook nearly as much to come to the United States or come to any other country and purchase products. So exports are without a doubt going to be struggling because of economics. When it looks at cheese specifically, we're looking at today at a $2.45 cheddar block and barrel price, whereas the world market is looking at closer to $1.70. So from a cheese perspective, regardless of economics, we're still way too high priced in order to get any type of cheese exports moving. That's going to be a struggle.
I think the other factor in there is not just our price in the world market, but also the value of our dollar. As that decreases or increases, that affects how much product can be purchased from the United States, and in many instances, gives the advantage to some of the other dairy producing areas in the.
Yep, without a doubt. Yeah, we've been kind of pricing in on the U.S. dollar index anywhere between 90 and 100, and that is towards the top end of the range. And like you had mentioned, it makes our goods more expensive for the outside countries to come and get versus maybe another supplier.
I'm going to shift again, and we've talked about the prices and the movement in the market, but for a producer, the first step in risk management is knowing your current cost of production. Understanding where is our break even. What's the second step for a producer?
Yeah, the second step for a producer, just like on the farm, it's coming up with a good team. At the end of the day, a good team cannot be substituted, whether that's in a banking relationship, whether it's working with the extension, whether it's working with somebody in marketing. Having a good team is necessary, because not only do you need to lean on them for education of certain products, but you need them to define risk and opportunity in a market, as well as be able to work through temperaments of your marketing. And what I mean by that is, how aggressive or how passive does a dairyman want to be, or what can they kind of handle in their marketing plans? There's a lot of aggressive strategies out there that can be employed, and there's a lot of very conservative strategies out there that can be employed. So finding that happy medium to fit your temperament is very important. So you have to find somebody that you trust, that you build a relationship with, and trust that they have your best intentions for you. So I would say finding a good team, just like on the dairy, and operating every single day.
Yep. And I think the aversion to risk, we all have different levels of there, and it's important that your team understand your placement in that scale. Often are looking at, the sale of milk and our product, but the other side of that coin is what's your future input needs, especially feed right now. Are you seeing an opportunity that producers need to be locking in some feed, getting some feed purchased, or locking in some prices?
Yeah, no, great question. So recently we have seen a drawdown in feed prices, and honestly, feed prices have been pretty soft this entire year since COVID hit, and a lot of different factors went into that. Ethanol fell off, so corn demand was hurt significantly. Yeah, absolutely. Right now, when you're looking at the December 2020 board, we're looking at sub 330 corn. When you look at corn the past 5 years, we once touched down close to $3, but our range has been over the last ever since 2013 or 2014, I believe, it's been $3 to $4.50. So when you look at December 2020, currently coming in at $3.30, we're very, very close to the bottom end of that range on D's 2020. When you look out a couple of years, 2021, we're trading at 362 3/4. So you can, in essence, lock up cheap corn for an entire year at probably levels that are cheaper than what you can even grow it at. You're looking at 2022, December corn is trading at 373.5. Those are very, very advantageous numbers. As we come into August, it does seem like the top end might be a little bit more limited given the fact that crop conditions on the USDA report look very, very good, and they're improving throughout the countryside. Most of the Corn Belt look very, very nice as far as the corn crop. I know in Iowa there's some issues in the western part of the state, but the vast majority of the Corn Belt is looking excellent. I wouldn't be afraid of locking in some of my needs, but as you kind of go into harvest, that's really the sweet spot for locking in corn. Anywhere between August, September, October really is when there are some really good opportunities for corn. On the soybean meal side of the equation, we have a soybean market that's sub $9 despite a lot of Chinese purchases recently. And when you look at the soybean meal market for 2020, all months are sub $300. All of 2021, we're either at $300 or a little bit beneath that. In 2022, every month is basically $301 or less. Whenever you get in that $280 to $300 zone, that's really good value for soybean meal. So I would be recommending taking a look at locking up soybean meal. And depending on how the basis is running, you can either lock it in through your supplier or use some type of tool where you separate the futures from the basis. So that'll be something to take a look at. And canola would be in the same realm of things. Canola has a really nice relationship to the soybean meal contract. So if basis isn't advantageous, then some type of separation of the futures and the basis would be a good play.
And moving into the forages, follow our regional market here in Northwest Iowa, and it looks like we've had some excellent hay coming in. A lot of volume, and our prices right now are such that I think now's probably a pretty good time to invest in some hay, get it under roof, simply because the prices look really good compared to the last couple of years, and what may happen if this drought continues. We could see some damage as far as the quality and availability. What kind of, we talked about the aversion to risk. What kind of strategies are you looking at for producers right now?
Yeah, so we're looking at many different ones, and it kind of goes back to the temperament of the farmer. In any type of strategy that is utilized, we're really keying on flexibility because there's a lot of different things that can play out in this market. And so we're looking at strategies whereas we use a minimum price strategies, put options, dairy revenue protection, LGM dairy could be utilized as well. For more aggressive producers, futures can be sold, but I would definitely be looking at re-owning the top side via a call option, as you do still have a couple of risks in the market. First risk would be selling lower than where the market ends up. The second risk is still the PPD if that spread stays wide. So you do have to account for that if you are looking at selling milk. Flexible strategies would be where I would be putting most of my attention. And the biggest reason why I'm looking at flexible strategies is when you look at the CME spot dairy auction and you look at product values that are traded and you plug that into a class 3 equivalent calculator, it does still point towards higher values than what are showing on the Chicago Board of Trade. So when you look at the CME spot dairy auction and you look at the product values that are listed and traded each and every single day, and you plug that into a class 3 equivalent calculator, it does actually point towards higher values. As of yesterday, that class 3 equivalent calculator priced out at $23.13. So when you look at the August price, we're currently trading this morning at $21.67. And then when you look at September, we're at $19.79. October, we're at $18.40. So what the futures board is really telling you is that they don't believe the product values will hold there for an extended period of time. You have to kind of bake into your strategy, what if they do? If they do, what will the market do as those prices expire? Currently, August has 35% price out of 100 on the CME spot auction. First week came in at 24. So far this week, we're pricing in at 23. Today, we trade at 21.65. So if cheese holds over the course of the next 2 weeks and 3 days, ultimately, we would see and expect a rise in price out of August. For me, I would be looking at a minimum price strategy for August, given that the math baking into that expiration is pointing towards higher price. We still want to have some coverage out there because, I mean, cheese could still get sold off hard. You never really know how that's going to happen over the course of the next 2 weeks, especially the way the market's moving. If cheese would hold, I would want some type of a floor, but most of my upside in September as well, knowing that we're at about a $2 discount between August and September.
I'd also point out that, there's no tool that can protect on the producer price differentials. So we've got to keep that in mind, that the price in your milk check's going to have some deductions in there. Matt, I sure appreciate the opportunity to visit with you. We shared a lot of good information. There's several good sites out there that producers can go to and get information. However, I think one of your opening statements was to create a good team. Have somebody that understands your aversion and the level you're comfortable with, and utilize them, especially right now as we're seeing a volatile market. Many thanks to Matt Tranel. He's a risk management advisor with Commodity Risk Management Group out of Platteville, Wisconsin. Enjoyed the conversation. We hope to talk to you again in the future.
Yeah, you bet. I would enjoy that. Thanks for having me on, Fred and Jen.
This institution is an equal opportunity provider. For the full non-discrimination statement or combination inquiries, go to www.extension.iastate.edu/diversity/ext.